sorry, I'm making this statement. The fund is not there for an investor. The fund is there to do what the fund is supposed to do. What is really fascinating me is that, you follow Warren Buffett for a long part of your career, and then you realize there's John Bogle who tells you just the opposite, and both of them have created so much of wealth.
Swarup Mohanty is the Vice Chairman and CEO of Mirae Asset. He has over 30 years of experience in asset management. He oversees assets worth almost rupees 2 lakh crore.
First thing that one has to do is marry your goal to the fund's goal. So the point I'm making is every mutual fund scheme has its own financial goal. It's very important for every investor to...
What should be the selection criteria when choosing a mutual fund?
Okay, the first thing is...
Okay, Swarup, so let's just get started. If we were to think about the mutual fund industry, there's always big headlines, AUM growth, XYZ, these number of SIP accounts. But today on the show on Temperament, we want to get into the temperament, I think, and the behavioral aspect of things. Can you throw a little bit more light on that, on how these biases actually impact a fund manager's, thinking and thereby performance?
Well, thank you so much for having me. It's such a pleasure doing this with you. But when you talked about the whole thing, you said you used the word significant. I would say it's about everything. At the end of the day, it's the bias that defines whether you get the full output of the whole process or not. The more the bias, the lesser the output is a reality. It's a business of discipline. It's very easy to say that one can be disciplined, but with the noise around you, and the human brain is not tuned to be disciplined because curiosity comes in invariably. So whether it's an individual investor or a fund manager, we are all human beings, and a successful fund manager is one who over a period of time cuts down on all the noise and cuts down the biases and focuses on the job at hand. While it is expected of a fund manager to do it, but it's also a difficult job because at the end of the day, he or she is also a human being. We've seen biases creeping in across, and then it's always very objectified as an asset manager to bring that out, do periodic checks, and then make them aware from the outside that there is a course of bias creeping in. And to be fair, any successful fund manager who wants to become successful over a period of time takes absolute heed of this and then does the correction course. And then the sooner the correction is done, the better for the fund and the better for the investors.
Absolutely. Another guest that we were talking to said that more than emotional quotient, or rather more than intellectual quotient, it's the emotional quotient that plays a bigger role. So how important is it for a retail investor's, process of thinking and behavioral patterns to align with that of the fund managers?
See, it's a very simple definition, right? The mutual fund is a pool of investors catering to a certain financial goal. Every mutual fund scheme has its own financial goal, which can be read by the investment strategy of that fund. It's very important for every investor to first read that it's available everywhere in the offer document, in the KIMS or the SIDS or whatever you call it. And the first thing the investor should do is to read that and marry your own goal to the fund's goal. I'm not sure many do it. People look at returns as a big part of their whole process. But this investment process is a very significant process in anybody's life. The more tangible you make it, the better it is for you. Every person has his or her own life goals. The whole objective of investing should be to convert your investments to secure those life goals. And in those life goals, the goal of a fund should not differ with your own goal. If you marry the two, the investment outcome can be a desired one. So that's where, from an investor perspective, it's always very, very important to check whether what you want from your perspective, from your portfolio's perspective, and match that to the fund's perspective. Now, the fund is not there for an investor. I'm sorry, I'm making this statement. The fund is there to do what the fund is supposed to do. Now, if your objective is that, then you come into this fund. right?
Can you give an example?
Suppose, say, a large cap fund.
Okay.
Let's take that as an example. Now, broadly, the objective is to invest in 85% of that money in pure large cap fund, which are the top 100 stocks of the country. Now, some people might want, these are strong, stable businesses. And as markets mature, I'm not saying, I'm just making a general statement, the upside of these companies could be a little lower than the smaller companies, which are in a far higher growth path than these companies. Now, somebody who wants quicker returns may not find it suitable in these kind of funds, could have to go for smaller companies with higher possibility of alpha than these. Now, it's very important to understand the behavior of large cap companies and see how they've made their journey. I'm not saying the large cap companies don't give returns or the possibilities of returns are lower, but these are stabler, larger companies than smaller companies. So if you are looking for a far higher return than what these companies are capable of, then you have to think twice. Like a better example could be the thematic companies, thematic funds. When you look at, say, consumption fund, their objective is to invest in consumption-oriented companies. Now, if you're looking at companies which are more, say, financial-oriented or infrastructure-oriented, these might not give you those companies. Now, I can go category-wise, but it's very important to understand that your goal and what you need from your requirement may or may not be available if we are not suiting your goal to the fund's goal.
Okay. So let's just get down to the basics of it. The fact that, we have a population of 1.4 billion, but yet the mutual fund penetration in the country is fairly low. What do you think that says about our own psyche or behavioral patterns? And given that you're saying it's such a simplistic thing, right? Like just pick out the good companies, trust your financial advisor. Why is it that the penetration is not more than it should?
It's about the history of our country, right? I mean, it's about the generations that are exposed to a certain asset class. Now, if I go to my father's asset class, that was the two big asset classes that play out in the country, real estate or the significant role that gold has played in anybody's savings or go to as an investment avenue. These were the two large fixed assets, as I may call, because gold in its physical, I will define as a fixed asset. And to be fair to that generation, fixed income used to give them very, very good returns, which would cater to most of their goals or needs. Now, with the deregulation of interest rates or the opening up of interest rates, lots changed. And that's when we guys came into the picture. We were the cusp between that generation and an open market phenomena, So we started moving a bit towards capital markets. And please understand, as we grow in our lives, bulk of the Indian population does not come from a very strong economic background. When you don't come from a very strong economic background, your risk-taking ability is only that much. So when you open up to a market where the risks are very different, you will approach it with a little bit of caution. Now contrast that to the next generation, which is my son's generation. Broadly, the economic status of them are very different. They are exposed to technology in a very different space. Hence, their thinking and their risk-taking ability and their approach to their life will be completely different to, say, my father and me. We used to look out for gaining assets. I think they will replace assets with experiences.
Yes.
When that happens, the way they invest may not have any what can I say, overlap in what we used to do. And that's when we feel things will break away. It's happened in every country and we are not any different. I mean, a boss of mine had told me that, people in any country buy capital markets equity when real estate becomes too high.
Mm.
And then he comes from South Korea. So if that's happened in South Korea, and I used to watch, when will real estate become too expensive? I think the time has been long time back, but whenever you buy a house, it's still expensive. People still aspire to buy. But fact is, the basic thoughts are changing. And I think when we discuss these things, say 4 or 5 years later, the penetration will be very different.
Okay. Now let's focus in on Mirae Asset. Can you give us insights in terms of, the schemes with the highest allocations? What are the factors? What is the criteria that's really guiding investment decisions for these schemes?
Since the core of our business remains mutual fund, And it's very similar to what happened in South Korea. We started as a long equity mutual fund, and then today have branched out into all types of financial services. For us also, when we regrouped in 2010 and started off again, we thought we'll start with the equity side of the business. Because at that point of time, if you look at the landscape in India, a lot of global asset managers were leaving the country. So very important for us in India to build a good balance sheet. And you can build a good balance sheet with long assets, and typically long assets come from equity. So to our flagship funds, then they were called the Mirae Asset India opportunities, which is the Mirae Asset large cap. And then there was the Mirae Asset emerging blue chip, which is now the Mirae Asset large and mid, which anchored this entire book and took us forward. Our view was very simple, was to put a business of conviction in front of people and build a track record. Finally, it's a business of track record. And if track record plays out over a period of time, people then get attracted to you. It's also a business of patience, huge patience. So if you track us from 2011 to 2015-16, while the funds probably were performing at their peak, we were Q1 in performance, people took their time to get used to us. But things changed after 2015-16. Before COVID, our AUM was around 40,000 crores. Today, we are a little shy of 2 lakh crores.
Yeah, 1.9 lakh.
Yeah, so, but that's not most important. For us, what gives us great satisfaction is the fact that we are a South Korean fund house sitting in India with almost 65-70 lakh folios with us. And to envisage ourselves as a retail fund house is something which we had never thought of. We bring consistency to the table. Fund management principle, both sides of asset class, is very simple: to buy a good asset at a good price. And that's the core of our fund management principle. We are probably one of the most diversified funds in the market. We don't take cash calls as a rule. And our objective is to give 40-50 good stocks in any portfolio at any point of time. When you look at the near-term market, I think some of our views have not agreed with the market because we've not found the market to be at a good price. So we will stick to our principle of buying good companies there, because over a period of time, again, cutting out the bias of an anchoring near-term bias, when you look at most of the companies that we own, we are extremely confident of their long-term earnings potential. Yeah. And if you take the journey with these companies today or tomorrow, that will unfold into the form of appreciation in the stock price or whatever way of shareholder giving us the wealth back. But the objective is to stick to those companies, and that I think we've done since inception. Our fund management unit is headed by Mr. Nilesh Surana. He's in the fund since inception. Actually, I joined it in 2011, so he's older to me in the fund house. Most of our fund managers have stuck on. We've yet to lose a fund manager as we speak. I hope I haven't spoken a little too early. But we also aspire in graduating a lot of our analysts to fund managers, both on the equity and also on the debt side. The last 3 years have been a learning on the passive side. Yeah. As a student of this industry, what is really fascinating me is that, you follow Warren Buffett for a long part of your career, and then you realize there's John Bogle who tells you just the opposite, and both of them have created so much of wealth for investors from the same underlying, investing in opposite ways. So as a manufacturer, our job is very simple: to create good long-term products. Yeah. Good track record.
And I think that really shows in terms of, the kind of performance that we've seen for some of the best performing funds at Mirae, be it the Mirae Asset, NYSE FANG, or the Asset Healthcare Fund. What should be the selection criteria, you think, for investors when choosing a mutual fund, typically? Any top 3 things?
Okay. The first thing is, ask yourself, why are you investing? That's the most important thing. You start with the purpose of your investment. Once you form that, then there are tools of finding out your risk profile. Okay. But I believe that, risk profile cannot be found out through a tool. It's a journey you take in your life, and your risk profile changes with your life stage too. Right. I mean, me as a 25-year-old single guy, risk profile, me married, me with a son, and now me accumulating for my retirement are 4 different risk profiles. So at least gauge your risk profile. And then with a goal, what happens? You become aware of how much money you need in what time.
Yeah.
With that, you come to a conclusion of what kind of returns that you're looking for. Sometimes it's very easy to find out whether those returns are feasible or not. If they are not feasible, then you change your goal. That is point number one. Point number two, from that goal emerges your asset allocation. And it's always prudent to spread your money across asset classes. Like today, for an example, the markets are beginning to become a little reasonable. Great case to be an equity investor, always a great case to be an equity investor. It's a growth asset. With the markets poised where they are on the interest rates discussion starting, it's also a great time to be a debt investor. And because of the fragility of the global data, commodities have been making a strong play in everybody's portfolio over the last 4 or 5 years, right? So as an investor today, you can allocate prudently across asset classes to form your goal, which is called your asset allocation. Once you form your asset allocation, then comes the scheme selection. According to your asset allocation, then you look for the schemes, and then I would definitely advise looking for a good advisor when you come to selection of schemes.
Yes.
After you form that comes the most important part. Please do in your lives always fix a review date. That is a big part of your investment journey. And in that review date, if you are on course for your goals, fantastic. If you are not, then do a little bit of rebalance. The rebalance can create a lot of positivity to your returns. I mean, I'll just give you an example. Our aggressive hybrid, say, rebalances once in a year, 70-30, 70 equity, 30 debt. That rebalance has added almost 2.5% return over its period of time because it just aligns it back to your asset allocation.
Yeah. And, I think that also investors are of the view, and this is something we hear about a lot, the fact that if you diversify, that increases your chances of compounding your wealth. But then there's also the issue of overlapping. For instance, I understand that 64% of AUM in India in mutual funds are focused on large cap funds. So if we have a total of 45 lakh crores of AUM with majority focused on large cap, isn't that a bit of a worry, or how challenging would it be to manage active funds while considering the psychological aspect as well of investor behavior with an overlap?
I agree with that till date, but let's look at what's happened in the last 2-3 years. We are probably the largest market of new issuance in the globe right now. Finally, a lot of those companies are now coming to the market. Hence, the options for fund management are changing dramatically. If you look at what's happened in the last 2-3 years and the number of new industries that have come up, so let's look at the asset management industry or say hospitals, there are hardly any large caps in that. So now the choice for fund managers are changing. And as we speak, earlier, when we look at giving an advice, we would typically give an advice of 70-30, stick to 70% large companies and 30% stick, then you can diversify to mid and small, taking an assumed factor of the other person's risk profile. But the risk profile is changing, as well as the number of companies being registered in the mid and small companies, strong companies. So going forward, I see that changing a lot. And fund managers now have a stronger choice of allocating good money towards some of large mid caps as well as new mid caps, and preferably some good small caps also emerging as we speak.
And you spoke of rebalancing. That's something that's important for investors to do. There's also a lot of underperforming funds sometimes, and maybe emotional biases can lead to a person to just stick it out or, not exit that mutual fund. Can you just give us a sense as to what are some of the classic mistakes that mutual fund investors make, and what is the outlook when it comes to exit strategy? Because not so many people talk about that.
I think the first thing that one has to do is marry your goal to the fund's goal. Once you do that, then you take a journey. Now, invariably in that journey, it cannot be a straight line. There will be ups and downs. Now, as a rule, you can imbibe some rules of how much of underperformance is acceptable to you. Like say, I put a 3-year rule, 3 year of underperformance with a good manager, I will review. Now, if the commentary from the fund house then suits me, fine. Otherwise, I'll take a call on my portfolio is how I look at it. So you can imbibe some rules in your portfolio. But what happens with strong fund managers, and I'm not allowed to give other fund examples, I would have given some classic examples, is that strong fund managers take very long-term bets. It should not happen that you lose patience the day and the fund manager performs the next day. So on the day of exiting some strong fund managers, you have to do a lot of homework on them. And there is enough data available. All fund managers do a lot of commentary in the market. Please listen to them. If they have a view on their portfolio, it is always wise to look at them and hear them before exiting. Exiting is very easy. If you exit, you drop out what is called the eighth wonder of the world, which is the power of compounding. And a lot of hard work you would have done, you would undo with that redemption. That is why the goals are a better way of redeeming. Once you fix a goal, you know when to exit. Now suppose, here's my other thing, suppose your goal is 12% return. Now fund is underperforming, but it is giving you 14%. Should you redeem? That I leave back to you. It's a question which is very, very dear to every investor. I would not redeem if I'm getting my 12%.
So I think we got the answer, what you would advise. And when people see market volatility, when they see a drop in the market, it is very natural. You tend to say, am I even doing the right thing? My hard-earned money is drowning over there. It is important for a fund manager as well to have a strong psyche and to be able to take these volatile times and downsides. So how important is the behavioral aspect for a fund manager at times of volatility, and what should an investor do also?
Both sides. I mean, see, in volatility always lies the opportunity. If there is no volatility in the market, there are no opportunities. It's just a one-sided thing. Then, alpha starts reducing. The last 2-3 years, if you've seen, the large caps have outperformed the benchmark because of the volatility. Though the small caps have performed, if you check the data, most of the small cap funds have underperformed the benchmark. This is a secular run, right? In a secular run, the index always wins. So, as an investor, one should always look out for volatile times. It gives the fund manager a good play to start discovering some value or price. And in volatile times, good fund managers do show their talent. And one is the science of looking at a fund, but the art comes into play in volatile times. And that's when good fund managers are differentiated from not so good. But a fund manager will always look out for these times. And there are two ways of doing it. One, your great stocks or your good buys are then available at different prices. And that's when you start accumulating them. So some of us who've been accumulating good banking stocks over the last 2-3 years will definitely gain when there is a upside to that.
Yes.
So that's something which fund managers do diligently.
Patience is a virtue.
Yes, and then you hold on to them. I mean, these are large businesses. Sooner or later, they will play out. Now, from an investor perspective, there are two things. One, a lot of people think predicting business cycles are very easy. Predicting business cycles need a different level of acumen. Leave that to fund managers, would be my humble request.
Yeah.
The rest is, once you've chosen a fund manager, take a good journey with the fund manager. He or she will definitely give you the fund manager's talent.
I think that emphasizes the point of, trusting a certified financial advisor is always the way to go.
Always.
What about your view on large cap active funds versus passive funds, and what kind of a role can the fund manager play, or how can they add value in active funds, especially in the large cap category?
I think we run both. So on the active side, we definitely back ourselves to beat the benchmark. But the last 2 years have given us those opportunities. But globally, data has said that once the markets mature and they become transparent, when they become transparent, mostly the information available to a fund manager is almost similar to the information available to the investor. That's when alpha generation starts shrinking. And that's when people start deviating to or start accumulating the index. Now, having said that, the index is also active. Suppose it's a market cap index, so stocks which fall into the criteria of those market cap remain, and at times when the market cap comes down, they also exit. Or if you look at the Nifty 50 over a period of 10-15 years, you would have seen enough in exit and entry. So you decide whether you want an active fund manager who will bring subjectivity to that same class of stocks, or you want a rule-based investor. Both have their merits, and trust me, both have equal power. It's up to the investor to choose of which way to take. I think a blend of both is great at this point of time.
Since we have you here with us, give us a sense as to what are some of the themes that you believe in the long term are looking promising.
See, I think from an India perspective, there are the core themes. And according to me, the core themes will always remain consumption as number one. We run a 13-year-old consumption fund, and please check that consumption fund and compare that consumption fund to any category. And look at the risk reward that the consumption category has given you. And as we speak, India consumption is getting re-rated. We are going from a low and mid-level consumer to mid and high-level consumer. So the story gets re-rated, the story continues. And the other part is, of course, the banking. 37% of Nifty 50 is banking. So banking and financials remain a core theme for all investors. And it's a diversified portfolio within itself.
Yes.
Look at when I started my career, it used to read banks. Then it became banks, NBFCs. Now it's bank, NBFC, financials. And as we speak, it's bank, NBFC, financials, and fintech.
Wow.
So the point I'm making is, if you catch a theme, don't confuse theme with sectors. Sectors remain where they are, themes evolve. The other theme which we are very comfortable with, and we run a successful healthcare fund. It's not pharma, it's healthcare. Pharma is the sector, healthcare is the theme. Again, when you look at us launching the consumption 13 years ago, it was primarily FMCG. Now it's a full-blown diversified portfolio. Similar is the healthcare. When we launched healthcare 5 years ago, it was primarily pharma. Now with hospitals listing, now we have insurance companies listing. Sooner or later, health is becoming such a big story that, you'll have pathological labs listing, and it just carries on. The next 10, 20 years do belong to healthcare unfolding in India in a big way. If you want to catch a big theme early today, my view will be manufacturing. That's just getting born in India. It's the next 15-year story.
The manufacturing renaissance is playing out.
Catch it early, India, and just sit. I mean, any healthcare fund over the last 5 years would have converted your money 3 or 4 times. But if you sit in them, you will start making. And my favorite example is our large cap on compounding, or large and mid. 1 lakh in 2022 or 12 is around 13, 14 lakhs today.
Wow.
Yeah. Now you just need, so it's 1 lakh per year, but you need 10% for 1 lakh more. You've done the hard work, but if you sit in some of these core themes, but what's happening on the passive side is very exciting themes coming out.
Yeah.
Themes are now being narrowed down to the futuristic. We launched an EV fund, and the young took it very well. We didn't advertise, but we got some 30,000 subscriptions. So the futuristic themes probably will come out a little bit more on the passive side than on the active side, is what I think.
And speaking of the performance, the Mirae Asset Healthcare Fund, for instance, the 18% annualized returns, you were talking about the mid and the large cap fund as well, AUM of 40,000 odd crore rupees. Can you tell us a little bit more about what factors contribute to the success of some of these outperforming funds at Mirae?
Well, it's just sticking to the core and remaining disciplined, right? I mean, if you ask me as an individual, and it's no rocket science to conclude that the healthcare of India is just about getting born. I mean, some of the penetration levels are still not happened. If I sell more medical insurance than I do of mutual funds, right? How many of us are medically insured at a certain level? And the growth of hospitals are directly proportional to the penetration of medical insurance. Yeah. As we start getting penetrated, the facilities that people will start getting will be very different. When you look at healthcare for the next 8-10 years, it's a no-brainer. So similarly for us, if we catch a good company at an early stage, our job will be to, take the journey with the company. Now, if you ask forget healthcare, forget everything. Let's look at any large company. You ask the promoter of that large company, is this the best time or is this the peak of your company? They will say they don't know. And you're expecting a fund manager to catch the best 15 days of that company. The job of the fund manager is to catch a good promoter and take the journey with the promoter. Invariably, the promoter over a period of time will reward the shareholders. When it will reward, we don't know. But catching a good promoter or a good company is most important. And differentiating between what is a good company and not so good company is the job of the fund manager. I think if you've seen our track record for 16 years, we've done it more often than not.
I think everyone knows the tagline, mutual Fund Sahi Hai.
Correct.
But still, everyone thinks there's so many asset classes to invest in. There's gold, you were speaking about real estate, direct equities as well as a space. What would be your messaging to people who still have that trepidation, or why should I look at mutual funds? What would be your messaging to them, even the younger people?
No, I'm a big fan of promoting direct equity. Okay. I mean, I would really look at the young to back themselves, study a bit because they can. So much of information is available.
Yeah.
Come to some conclusions on some companies. If you can do that, fantastic. Because that's the game, right?
Yeah.
But if you don't want to do it, you have two other ways. Hire an active fund manager and let that person do it at a very nominal fee. At the maximum, we charge 2.25, and that's not anything very expensive. And let that person do the job. But remember one thing, once you give it to a fund manager, don't be a fund manager over the fund manager. Let that person do his or her job. And in India today, after 30 years of the mutual fund industry, there are extremely pedigreed fund managers in this. So choose you are spoiled for choice there. You can choose the right ones. The other part which is emerging is, of course, you can go for the rule-based passives, and that too, because of categorization of mutual funds, the ideation on that side is a little now stunted because the regulator has laid down these are the category of funds. But on the passive side, because wherever there is an investable universe, we can create an index, and through factors give you multiple ways of that index. The stories that will unfold are also very interesting in the times. And so from a youngster perspective, I think they have a great life ahead. First, choose what you want to do with your life and marry your investments to your life.
Yeah.
Make it tangible. And once you get your life out of this, it's a different high.
Then there's thematic funds, and I think of late as well, we've seen pretty decent inflows into the thematic funds. What is your outlook on the fact that there's a lot of advice on when to enter into these funds, but given their cyclical nature, the strategy on exiting is not that clear? And how would you pit thematic versus flexi-cap?
Please don't confuse thematics with sectors.
Okay.
Sectors are cyclical. Thematics are a perpetual play. Themes develop over a period of time. I'll give a very classic example. Our global ETF company is Global X. They launched their social media fund before Facebook. I'm not talking about IPO Facebook, before Facebook. Somebody thought of that then. Their lithium fund is in the 9th year.
Wow.
Our consumption fund is in the 13th year, right? And if you see the evolving nature of most of the themes, I explained the banking one to you, but if you look at, say, healthcare today versus healthcare 10 years later, the stock composition today and the stock composition then will be completely different. The simple point I'm making is a broad theme tends to become diversified. A sector, which is a subset of a theme, is definitely cyclical. The question that you are asking me is more to do with the sector than in a theme. And globally, that's why people have now evolved more to thematic investing than pure market cap investing.
Okay.
Now, you have a case in the form of flexi-cap. Yes, fund managers can cut across and give a very diversified portfolio. I again bring back to what I discussed earlier. Earlier, because of the nature of the market, most flexi-caps tended to be large caps. But I do foresee the next 4 or 5 years of flexi-cap being true to nature and being far more diversified across market caps.
Okay.
And hence can be a good competition to some of the other categories if managed in a pure flexi-cap manner. I'm sorry to say, but if you look at the flexi-cap portfolio till date, and that's a factor of the market itself, they've been more large cap than the name flexi-cap. But hopefully some of us will start graduating to demonstrating a pure flexi-cap. If that happens, then I dare say your question is valid, not taking away anything from the potential or the long-term potential of a consumption fund. Again, please compare the consumption fund performance till now to any flexi-cap in the market from standard deviation to whichever ratio, and you will get the answer yourself.
Okay, now going to one of your best performing funds, the Mirae Asset NYSE FANG, the fact that there is no fresh money and there is an AMC-wise threshold, can you elaborate a little bit more?
The FANG Plus has been a learning to me in life. When we launched the FANG Plus, it was a 10 stock, disruptive tech companies in the US or global, whatever you call it. Now, it was the riskiest portfolio that I have ever sold in my lifetime. So when we launched the fund, I was making a presentation and it filled up the whole thing with risk factors. And somebody asked me, Swarup, are you asking for money or are you scaring me? But what unfolded was pretty staggering. It remains one of our largest held retail funds. Over, I think, 1.5 or 2 lakh customers in that already. Now, because the industry has a 6 billion threshold and we've hit the threshold as an industry, that fund is closed for subscription from our end, but the ETF is open in the market. But because of the demand for that fund, the ETF trades at a premium at times. My humble request to investors will be not to buy it at a premium. Buy it closer to the price, and that's always prudent. Don't fall prey to the greed and buy it at a premium would be my, what can I say, screaming kind of a
From the rooftops.
an appeal. Please don't do that. But people are buying it, and we don't know who's buying it at the end of the day. It's bought as stock. But when you look at those 10 stocks, these are the 10 largest disruptive tech companies of the world. Some of those companies are larger than our economy itself. So the merit of the portfolio is there. I hope and pray someday it gets opened out. What it taught me was the change in risk profile of this investing universe in India.
Everyone wants a piece of that pie.
Please, today we are calling it a top performer. The fund had gone down to 25% from its IPO price or the opening price. But all I got was, why is this fund closed? Why are you not opening it out for purchase?
Yeah.
My erstwhile investors would have said that, this is not a good fund and it's tanked 25%. Swarup, what are you doing?
Yeah.
But that's not what I heard from the investors in this fund, which just signifies the change in the risk profile of people, the ability to understand the potential of stories and the ability to hold on. And when they held on, what's happened post that is very different. It has a long way to go. Those companies will get larger. These companies have the potential of buying out their competition. And there's so much of money with them. So the power of that portfolio is getting recognized. But unfortunately, it's closed at this point of time.
And then I think off late has been the buzzword with respect to the quant theme, and wanted to understand your take as to whether or not it can work. More mutual fund houses seem to be adopting this as well.
I think we started this discussion based on temperament and behavior. The Quant kind of exemplifies that because it is rule-based. Globally, the Quant guys are the most sought-after guys, and because it just simplifies everything into a rule. And once you make it a rule-based business or a rule-based formula, it just follows the rule. It is the optimal way of discipline. So I'm a big fan of Quant as we speak, but Indian markets come with their own issues of liquidity. Hence, we've held back on coming out with a Quant fund. I think we're still looking for a good talent there. The moment we get one, we will definitely launch that. But you cannot take away the merit of Quant investing. It's a matter of time that it will evolve. Once some of these basic elements of liquidity in the market are addressed, which are getting addressed as we speak, because earlier selling a illiquid stock was impossible. Make no mistake, even today, Indian markets remain very illiquid across market cap. It's not that a small cap is illiquid or a large cap is liquid. No. You go to sell a large stock at a particular time, it's difficult to sell, right? So once those are addressed and the markets become far more liquid than what it is, the quants will emerge. And there will be a time when this will be the go-between active and passive, complete crossover. The quant is what will fill in that gap before it goes completely to the passive side.
There's multi-asset category as well. I just wanted to get in your thoughts on this in terms of whether it's a prudent strategy for an investor to adopt investing in this, and the fact that they're charging a 1.5 to 2% expense ratio, is that justified?
Yeah, it's a very interesting question because I had that question when this entire category started off. But what struck me was this whole thing of asset allocation. And then when we did the simulation, and the simulation is there for anybody to check, the ability of these allocations playing out on the possibility of giving a more, disciplined return over a period of time struck me. So the return band between 13 and 18% in a multi-asset were more probable than a fully invested equity. Now you have to think whether that is acceptable to you or you want to go full equity. I completely agree with your basic question. I'm getting the underlying that why is a fund which is invested 50-60% in equity charging a full equity charge, right? But when I looked at the data points and what struck me and why I became a fan of this category is that the possibility of a long-term disciplined return because of the dynamism of the market. And look at, I've been one of those guys who stood up on stages and said equity is the asset class for growth. But when you look at the 10-year return of the index versus the gold, guys like me are thinking twice, right? So the ability to allocate
Got it.
and get the optimal of these asset classes in various times plays out in the end result.
Okay.
Now, please understand, the charge that we make is a factor of the market. Over a period of time, if this charge or this cost is not acceptable to the market forces will change it, and then the asset managers will change it accordingly. It's very early days, but this question is valid, and I will take that home as a consideration for sure. But the data points that came up
Understood.
is very contrasting to what I had thought.
Right. You know, with the kind of experience that you hold and the number of years that you have been here, gone through volatile times, ups and downs as part of the journey, what are the key learnings?
I think the first and foremost learning, which remains always, is it's a fiduciary role. When people entrust us with their money, and I think I must have done something good in my last birth to have got this job. And I think the endeavor will be to always retain that fiduciary capacity. If I end my career without a blemish on that, I'll be very happy. The second part, obviously, is to stick to the principle of fund management. I mean, whatever you've promised, you have to be true to the label. Sometimes the market may not be on your side, but you can't deviate from the label. If you can hold that on for a period of time, the outcome always comes out. And then to have that conviction in that process is second. And to be fair, I'm so happy to say that I'm backed by a fund management team which does not deviate from that at all. And that's been a learning from them. The third most important part is when you start off as a young person, you think this is a return generating process, but it's actually a risk mitigating process. It's a business of risk management. And the better you manage the risk of all your portfolios, the outcome will be better. And that's a learning which came a little late, but I'm thankful that it's come. So we hold our risk profile just like that.
Wonderful. And I think numbers really tell the story. So you've not done something great. I think the fact that you've been giving these kind of returns and been so meticulous, you and the team really is a testament to the investors entrusting their faith in you. Thank you so much for joining in. But any last messaging or any last words you'd like to leave viewers with?
No, thank you so much for having me. But from an investor perspective, I just like to say that there is a risk to investing. There is a risk to not investing. There is a risk to investing in equities. There is a risk to not investing in equities. The risk to not investing in equities, looking at the future of this country, is very large. So please do not delay your investments as much as possible. The best time to buy is when you have the money.
Okay, thank you so much. It's been lovely speaking with you, so enlightening. And I think some of the key takeaways would be that biases definitely play a big role when it comes to investing. It is important to align your goals with that of the fund. And the fact that sectors are just cyclical, but it is the themes that are evolving.
Yeah.
And most importantly, do remember to consult an unbiased certified financial planner. Hope you enjoyed watching. What were some of your key takeaways? Do mention in the comments section below. And do remember to subscribe to Personal Finance TV. I'll catch you in the next episode.